Now the S&P overall does look very mixed today in terms of the results, but more importantly, and the focus of today's episode, Nvidia itself is down 2.5%, and it hasn't been on the best track run just over the last few weeks. In fact, down 2.3% now, down 5% over the last month, and if we take a look at its 52-week high of $153, right now it is trading 15% lower. So what are the issues that we see in terms of why the company is down? Is it still a good company to hold, and perhaps a company we should consider buying the dip? Now we have an article that was released today that talks about whether or not the issues that is faced with Nvidia affects the broader market as well in terms of the AI stocks, and we're going to cover some of those talking points today. As we can see, in fact, the month's decline of 5% has put Nvidia down around 12% from the November high, and as we saw, down 15% from its 52-week high. And one thing we also need to incorporate is that a market correction by definition happens when there is a decline of 10% or more from its peak, and therefore we have to say right now Nvidia is in a correction. Now, what's interesting to note, when we look at other companies in the semiconductor space, Broadcom has been performing extremely well last week after their earnings, and in fact they're up again another 8% today. We have Micron Technology, one that I did speak about just a few days ago, that is up 7%, and that is anticipated in terms of their quarterly earnings on Wednesday. A lot of bullish sentiment, and that also expands to other semiconductors that are up by at least 1%. So we need to understand what are the issues that is happening with Nvidia, and is it something serious? So there are three things that we want to highlight from this company. The first one is the seasonal trends. Now, December has historically been a weak month for Nvidia. If we look back over the last 10 years, on average, this company has been down 2%. Now, the seasonal softness isn't earnings related, but rather part of the broader market trends as well as the year-end trading dynamics. Then we move on to the second factor of why they're down, profit taking. After their incredible performance just over the last year, in fact, as we can see, they are up year to date in 2024 165%. Therefore, we also have to understand that investors may be looking to lock in profits as 2024 comes to an end, and therefore has no bearing on their overall AI dominance, so the current decline could literally just be a part of normal market adjustments. And then we factor in the broader market pressures as well. We've noticed the recent market sentiment appears to be cautious, where we were sitting around neutral, now moving slightly into greed, and this is all due to the fact that we have interest rate cuts coming, and the Federal Reserve was a little bit hawkish about the anticipation of rate cuts into 2025. We have the broader tech sector as well, which was experiencing some pullback, and that also contributed to Nvidia's decline. Now, these factors combined do suggest that today's drop, alongside the drop we saw last week, aligns with the broader trends and individual stock dynamic rather than any major new developments specific to the company. But we don't believe the underlying investment thesis for Nvidia has changed, and the fundamentals, whilst they have looked historically strong, still continue to look very well. So let's see whether we should be buying the dip and if there are any other fundamental issues. As we said, year to date, incredible performance. Over the last 10 years as well, up more than 25%, incredibly outperforming the S&P 500. And as we mentioned at the beginning of the episode, it is down around 15% from the 52-week high. Anything at 10% or more of a drop is considered a correction, and that is where we are seeing Nvidia right now. Wall Street giving this a strong buy, seeking alpha with a buy, quant with a hold, although as always 3.49, not far off the 3.5 to flip them to a buy. They do pay a yield very small, 0.03%, and the forward P 45. Whilst it does look high, we will talk about the expectations and where the forward P should sit. So moving to that sector, we can in fact see over the next 4 quarters, they are anticipating double-digit growth to the earnings per share year on year, and over the last 4, they have outperformed, giving them a 100% historical forecasting accuracy, which in turn should give us faith that they will hit their 4.43 EPS anticipated for January 2026, and that would bring the forward P to 30.3, which is where we do believe it should be sitting right now, because the January 2025 year end is literally next month, so the forward P should be from the following 12 months, and that is why we do believe that right now the forward P for Nvidia sits around 30 to 31. Now, in terms of the underlying metrics, we've already gone through this, so we will be fairly quick, but the dividend safety score at 89 shows very safe. The valuation undervalued, as we'll come to show you, and as I'm sure you're aware, they did increase the dividend triple digit 150% in May this year. In terms of how they performed in the last recession, so 07-09, no dividend was paid, so no comparative data. Below average growth, -35, the S&P itself, -12, but they also massively trailed the S&P, -78% return, the S&P, -55. Now, they have increased the dividend at a triple-digit rate in May this year, but on average, over the last 5 years, it's only up 1%. Over the last 10, up only 7%. This indicates to us that management and their capital allocation priorities doesn't see dividend increases as part of that program. Now, in terms of the valuation, this is based on the forward P, with the blue tunnel being the expected fair price. Right now, it is significantly lower, even the bottom end of this range, indicating severe undervaluation. But remember, we're not looking at this model in isolation. We will conclude when we run it through our own DCF model. As always, we do ignore dividend yield theory for a company with a low yield, one that they don't really consider in terms of growth over the longer term. So we draw your attention to the forward P, which right now at 33 sits below the 5-year average of 42, again reinforcing the undervaluation we mentioned above. But as we can see, it does right now trade at a premium to the overall sector. Remember, some companies do deserve to be trading at a premium, and we do believe Nvidia is one of those, as we will come to show you when we compare their stats against the sector median. Free cash flow payout, we'll just say very briefly, is looking very good, well below the minimums we want to see, decreasing 1% on a trailing 12 month. As we've said before, if they really wanted to, they could do triple-digit increases, even a quadruple-digit increase to the dividend, but it's not really part of their capital allocation. They want to focus right now on share buybacks, as we have mentioned in previous episodes. Again, something just to highlight, we don't typically look at earnings on this channel. We focus on free cash flow, as earnings data is susceptible to manipulation by management through accounting. Now, free cash flow, consistent long-term growth is what we want. Now, it has been very rapid, although we do have to note the majority of that increase has come in from 23 to 24. On a trailing 12-month, again, a very rapid increase, and another large jump anticipated over the next 12 months. In terms of sales growth, nearly double-digit every single year. In fact, the last full year, triple-digit, trailing 12-month, triple-digit. That means we are anticipating for January 2025, next month, when their full accounting book closes, another very strong year for Nvidia, especially on that top line. And as we can see here, total sales 61 billion in 2024, massive increase from 2015, but also look at that on a trailing 12 month, we do anticipate they will probably more than double the previous year. The other thing we want to flag is shares outstanding. Now, we want to see companies return excess cash to investor pockets through their share buybacks. What we can say, they've done the opposite. If you were a shareholder in 2015, they would have in fact diluted your position over the last 10 years. Why we wouldn't really care right now for Nvidia, they have massively outperformed the S&P, so it wouldn't be a worry. The other thing that we do want to say is, from a few years ago, they have started to do a lot of share buybacks, and they have a massive authorization program, so something we do anticipate we will see a lot more of over the next few quarters and likely over the next few years. Now, ROIC, one of our favorite metrics, 12% or more for the semiconductor space, looking very good. Now, 61 in 2024, 92 on a trailing 12 month. Investors will find that incredibly attractive, and remember, this gives us faith that management are able to effectively allocate their capital. Now, if you just watched our AMD episode, we did talk about how they had a lack in operating efficiencies. That isn't something we have to say for Nvidia. We notice not only above the minimum we want to see, but massive efficiencies, 16% in 2015, 54 in 2024, 63 on a trailing 12 month. And remember, that is the criteria that we do want to see for high quality companies, increasing revenue as well as increasing margins, and no worries whatsoever with the free cash flow looking very healthy, 50%, very impressive on a trailing 12 month. Then we get to probably one of the best metrics, the net debt to EBITDA. The numbers that you see below are the number of years it would take them to pay off all of their debt net of cash on hand. This signals to us last 10 years and over the next 12 months, it won't even take them one day to pay off all of their debt net of cash on hand. Incredibly impressive, and shows us they have a very strong balance sheet, and we will highlight that later on. Now, we also want to let you know we have released our latest 3-week article where we run through 2 beaten down quality stocks that have hit our buy alert. Now, we send one of these to your inbox every single Monday morning, and we highlight severely undervalued stocks for your attention, as well as what's gone in the market over the last few days. So click below, you can sign up, start reading straight away, where you'll gain access to 28 undervalued stocks for the month of December, the upside that Wall Street themselves see over the next 12 months. And on top of that, you can grab a recently released copy of 29 stocks that Wall Street themselves believe right now have the most upside in the S&P 500. So click below, you can sign up and start reading straight away. We also like to look at insider ownership, which sits at 4.2%. Now, we notice 1 billion worth of sales by these insiders over the last year, and in fact in Q4, 46 million. Now, we'll show you for essentially giving you that transparency who these insiders are. The most recent one, 13th, so just a few days ago, by the CFO, selling around 66,000 shares, netting them $9 million. Now, remember, this isn't one that we do include in our own investment thesis, as they sell for many reasons, both personal and financial. And then institutional ownership sitting at 65%. 31 billion worth of sales by the institutions over the last year, a lot more buying, 290 billion in the same time frame, meaning they are very bullish on this company, although we notice a large portion of those buyers in Q2. In Q3, just a marginal amount more buying than selling. Regardless whether they're bullish or bearish, always do your own due diligence, never copy blindly what insiders or what the institutions do. Now, we've already highlighted their income statement, more importantly, their top line revenue. As we said, very impressive growth, most impressive just over the last few years. And on the trailing 12 month, we do anticipate another very rapid growth rate. What we wanted to flag here was their bottom line net income. Does it follow a very similar story? And the answer is pretty much yes. Over the longer term, very nice growth. We do get a bit of a drop from 22 to 23 before a massive jump into 2024, 631 million to 30 billion. And as we can see, more than double on a trailing 12 month, giving us that indication, not just 2025 top line going to be impressive, but also we expect the bottom line to follow suit. In terms of a quick health check, total cash versus total debt, although we did highlight balance sheet does look very strong. Like many of their other metrics increasing over the longer period, so has their cash from 4.6 billion to 38 in the latest quarter. And as always, one number here in isolation isn't going to tell you anything, so we compare it to their total debt numerically and directionally, which has increased over the period 1.4 billion to 10.2, but as we saw, their cash balance is far superior. It won't take them more than one day to pay off all of their debt net of cash on hand. The other thing we wanted to highlight is their cash from operations. Over the long term, pretty much a similar trend to their revenue, has been increasing. 906 million was how much they generated from operations 10 years ago. On a trailing 12-month basis, 59 billion. That is absolutely incredible and significantly high, especially when compared against the sector median. Now let's get into some gradings. They do get a D- on the valuation. Now, as we said, we do believe the P on a non-GAAP should be more around the 30-31 basis, but even so, the conclusion is the same. The sector median does trade lower at 26.4. So right now, if you are buying Nvidia, even after the dip that we are seeing, 2 to 3%, you are paying a premium on pretty much whatever valuation metric you use. Now, is it worth the premium, and how much of a premium? Let's answer those questions. First one, A+ on growth. So yes, very likely they deserve a premium. 152% revenue growth year on year. Sector at 4. Moving forwards, 93%. Sector at 5.5. And as we can see, earnings per share over the next 3 to 5 years, 38% expected, sector at 15.3. We then move on to profitability at an A+, gross margin 76%, a lot better than the sector at 50.4. Bottom line margin 56%, a lot better than the sector at 3.8%. And we can also see, and as we mentioned, cash from operations is not only impressive at 59 billion, but much higher than the sector median at 98 million. So yes, it does deserve a premium, and we're about to get into our valuation model to show you the margin of safety. Just a quick summary: strong buy from Wall Street, buy from Seeking Alpha, hold/buy from Quant, D- on valuation, A+ on growth with an A+ on profitability. Two more things just to highlight their comparable performances. Firstly, against others in the semi space. Over the last year, total return including dividends reinvested, they are the best performing, even better than Broadcom, which did shoot up just over the last few days at a double-digit rate. Over the last 5 years, again, conclusion the same, no one comes anywhere near. And over the last 10 years, again, that conclusion is untouched. Remember though, past performance is not an indicator of the future. They could perform a lot better, they could perform a lot worse. Now likely you know the answer, but as we can see, Nvidia's outperformed the S&P over the last year, outperformed over the last 5, and outperformed over the last 10. Just something though we do like to bear in mind when considering whether we have faith with individual stocks or we should stick to a low-cost ETF that does track the S&P. Now let's jump into the valuation model where we get our intrinsic value at $140 derived from the DCF model. Now as you can see, the free cash flow year on year over the last 5 years, their free cash flows have grown year on year 135%, year on year over the last 10 at 94%. So we've gone for 30%. Now we have a low, medium and high rate. With the 30% and the discount rate, we get the present value of future free cash flows and terminal value. Now we've shown on previous episodes that the 2025 position is incredibly conservative because right now, only 3 quarters into the year, they are well above that. So bear in mind, this is a fairly conservative starting point. So we add together the present value of those free cash flows with the cash, subtract total debt, get to the equity value, divide by the shares outstanding. And as we get here, $140, indicating right now only 7% upside. Bear in mind, these numbers are subjective. You can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it is for Nvidia or any others. Full transparency though, we will show you at the 25% level, this is intrinsically valued at $101, downside of 23%. At 35%, intrinsically $193, upside of 47. And for those that have seen Bloomberg's article last year where they said this industry alone is going to grow at 42%, if you are more in line with that, well, $300 or thereabouts, indicating more than a double at 127% upside. Now we're going to take the median rate of 30% in today's episode, where we always apply a 10% starting margin of safety, execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. If you believe that in today's episode, a buy up to $126, which tells us right now it still only has a 5% MOS, but for some people, they will be happy to even pay a premium for a quality company like Nvidia or even a 5% MOS. At 10% though, as you can see, a buy at 126, at 15 at 119, at 20 at 112, and at 25 around $105. So 5% margin of safety. Wall Street themselves price target 175 untouched with upside of 34% over the next year. As always though, give us your thoughts in the comments below. Is this one you are buying the dip, maybe holding, or for whatever reason you are looking to sell yourself as well? Don't forget to sign up to the free weekly newsletter, grab those 2 spreadsheets, and come and join us in the Patreon where we do talk about our weekly buys and sells. As always, have a great day, and we'll see you all on the next one.